We said this was going to happen. I'm your host, Steve Van Metre, and thanks for joining me today. And layoffs are about to surge as Black Friday is leaving retailers in the red. Let's head over to Bloomberg, where we picked today's story up as U.S. shoppers kick off holiday season with a muted Black Friday. U.S. retailers discounted heavily on Black Friday to clear out bloated inventories, but customers responded only with modest traffic, leaving profitability in doubt for many chains. Now, if you're wondering why this matters to profitability, it's because retailers run in the red. They run in a loss all the way up until this time of the year, and on Black Friday is when they do enough business to put them in the black going into the end of the year, and right now it's looking like they're going to be stuck in the red. And it doesn't make a lot of sense because they've been driving inventory levels so high. They're sitting at record levels, as we can see here from the retailers' inventory data, that are sitting just way off the charts, over 700 million in inventory, and no sign of it slowing down. So retailers need to bring this down, which suggests that we're going to see even heavier discounting in the future if this inventory aren't cleared out. And demand, well, it seems to be dropping right off the cliff. Crowds were thin in the late morning at Connecticut's Stanford Town Center Mall, with fewer shoppers at a jewelry and apparel store. A company at Walmart near Dallas revealed the lack of crowds as they bought presents. And in a Stone Town Mall in San Francisco, shoppers were few and far between. It feels like a normal day, says Miguel Martinez, a warehouse supervisor walking through a Target store in Chicago's North Side. He noted that he's been cutting back on cable TV and Netflix to afford presents for his 4 children, and he noted that the discounts, well, we're pretty good. And I think we're going to see more of this, where consumers look at their budget and start saying, hey, do I need cable? Do I need Netflix? Do I need these other things? And you're going to watch them cut back because they just can't afford these higher rents, higher energy prices, higher food prices. So they're going to have to cut, and particularly after the holiday season, because as we already know, credit card interest rates are going higher, means minimum payments are going higher, and consumers are going to have to cut back even more. U.S. consumers are still spending, but they're growing more cautious after contending this year with the highest inflation rates in 4 decades. They're also keeping a sharper lookout for deals, and retailers, many of them still heavy with inventory, not only still heavy, at record level inventories after misjudging an erosion in demand, are trying to stand out by dangling the deepest discounts since before the pandemic. And really, this doesn't make a lot of sense to me, because when we think about the position retailers were in, they knew that fiscal stimulus was going away. They knew that monetary stimulus was going away, and yet they continued to say, hey, we need more, and more. And yet on the consumer side, what did we see? They just can't afford it. This chart here is real disposable personal income. We now know that it's back to pre-pandemic levels. So consumers it's not a matter of the fact that prices are higher. Their wages, their disposable income, it's just not keeping up. They cannot afford these goods even if they wanted to, telling us the prices are going to have to continue to fall. And what baffles me as we look at the ISM Manufacturing Purchasing Managers Indice data from October, what do we see? Customers' inventories. The data here says it's too low. In fact, it's not only been too low, it's been that way for 6 years. 6 years. We're talking about 73 months of trend that retailers are saying, look, our inventory level's too low. At what point does that switch and say, not only too low, not is it too high, it's way too high, and they cut back? And of course, that's just one step as we talk about how layoffs are going to increase. The U.S. holiday shopping season is likely to see modest to break-even growth in annual sales, which is a huge red flag, and that's still a win, according to some experts, contrasting the outlook with the UK. Well, hey, it's not as bad as it is over there, where high inflation has caused consumers to pull back noticeably on spending. Still, the steep Black Friday discounts are likely to squeeze retailers. And when are we going to find this out? Well, not until next quarter, when we're in the first part of the year, where we finally see fourth quarter earnings and sales. That's when it's going to show up. In the meantime, we're going to hear stories. We're going to see data suggesting how bad it might be, but the real information won't be till next year. And what that means is advanced retail sales, if we just have a muted holiday season, it means the trend rate here shown on a year-over-year rate of change is going to continue to decelerate, and that is a red flag for the employment market. Profits will not only be where retailers want them to be, that's in part because they couldn't pass all the inflationary costs up to consumers. And again, it's not about passing costs off to consumers. The issue is with higher rents, higher energy prices, and higher food prices, and a lack of wage growth, consumers just can't afford it. It's not a matter of, hey, we got the pricing wrong. They can continue to lower the price of these goods, and they'll be forced to, and watch, they're going to sit. And here we can note that consumer prices are at the highest level of 4 decades. And of course, this is just compounding the problem because e-commerce spending on Thanksgiving rose 2.9% to $5.29 billion, according to Adobe Analytics. And that's far less than the U.S. inflation rate of almost 8% during the 12 months ending October. And again, all this is validating what we already know is inflation went up too fast, the Fed was too slow, and employers did not want to give big raises. And now all of a sudden, we're going to see this coin flip the other direction as employers are going to pay the price as demand goes down, profits go down, earnings go down. But of course, we know in the end, employees are going to pay the ultimate price when they get the pink slip. Salesforce said the average consumer discount on Black Friday was expected to be greater than 30%, up from 28% last year and close to the 33% rate in 2019. The biggest discounts, well, get this, were in home appliances, apparel, health, and beauty. You think of appliances, that's the housing market telling you there's a slowdown. How about apparel and health and beauty? Well, if you don't have a job or you're working from home, you don't need to spend a lot of money on that. Again, a sign right now of where the economy's headed. But shoppers are cutting back in reaction to higher prices. People are just plainly buying less products because their dollar isn't going as far as it used to. Well, we've already made the case is they just don't have the dollars that they used to. And here we can see average hourly earnings, less inflation of the consumer price index. And we can note that going back into 2020, that consumers have seen their wages stay behind inflation. Again, they don't have the money. In exchange, they racked up their credit card debt and now putting them in a situation that they just can't afford these goods at almost any price, which means we know we're going to see inflation coming down even more as retailers and wholesalers are forced to discount even heavier in the next year. But crowds like that appeared to be an exception as the checkout line of the toy section at Macy's in Stamford, Connecticut had no wait, and the cashier said the store had prepared for more shoppers by hiring, well, you got it, more people. A Walmart in suburban Dallas had also had cashiers standing at the ready with no lines, which was just fine with some shoppers who were visiting, and all this translates into is layoffs as we started the show. And here you can see advanced retail sales in blue on a year-over-year rate of change against the 4-week moving average of initial claims, and you can notice they look fairly like a mirror of each other. But as we see retail sales slow down, which we now know is happening and will continue to happen, what that means is retailers, wholesalers, they all need less employees, and that means we should be watching initial claims are likely to head higher into the later part of this year and into early next year, validating what we already know as we're headed into a recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.